on that. But all
Yeah,
these
that's
things
great.
tie
I
into
know
me, and I
Jordan,
think
and
that
he's actually
that's
we're
that's one of the things
colleagues,
that I
and
find kind of interesting.
yeah, Jordan's a master, so you'll learn
Yes.
a lot from him.
Can you hear me?
He's a gold expert.
Secondly, how do I sound?
And
Is my sound acceptable?
Jordan, how's that? What does everybody else think? A little bit too loud. Maybe take it down a little bit. Might be overmodulating a little bit there.
Okay. Is that a little better on the volume? I know, but part of my problem is I'm generally kind of a loud person, so I got to turn that volume down. It looks
Yeah, I
like
think the volume's great. It's just when it gets loud, it might modulate a little bit, but it sounds like it's coming through clear now. So, guys, I'm going to go ahead and turn the room over to Jordan, and it's all yours for the next 30 minutes.
Alrighty, well, thanks so much, Chuck, for inviting me, and I'll try and be quick here. And the title of my presentation is The Setup for a Gold Bubble. But, I mean, when you think about a bubble, you're really thinking about something that is so beyond what should be happening in terms of valuations. But some of the charts that I'm going to show you here today, I think a more apt title would be just a case for really, really high prices. And just looking at a lot of historical things, and we're also going to look at why I think we had a major bottom in May, and I kind of go back and forth between looking at gold, the metal, and also the stocks. And I know this is probably primarily a trading audience, and trading gold in the miners is so much different than trading another sector. But what I'm mostly going to do here today is kind of talk about the bigger picture, talk about the fundamentals, and really talk about what I think is setting up over the next 5, 6, possibly 7 years as we get to the end of this bull market. So without further ado, let me get to the slides. And so there's 3 parts here. And again, I'll try and get through this as quickly as I can, so maybe we'll have time for some questions. So essentially, reasons why we had a major bottom in May, a long-term case for the bubble, and what I'm doing personally and in my service, how I'm applying those things forward to make money. Okay, now here's one sentiment indicator that I look at. Which this is from sentimenttrader.com, but it's using RIDEX funds, and they show this for a lot of funds, and this is the RIDEX Precious Metals Fund. And what we're looking at here in the middle column is essentially how much money is in the fund, and obviously if there's not very much money in the fund, you can see where the circles are. The first one was in, first one was in late 2008, and again the second one was this spring and this summer. And the bottom portion there shows the percentage of the assets in the precious metals fund, and this is a stock fund, it's not a metals fund. The percentage of the assets in that fund relative to all the other sectors, so comparing it to technology, in the entire market, it's added up. And you can actually see in that bottom column that relative to all the other funds, you could say that just based on this RIDEX fund, gold stocks were more hated at any other time, in I believe that's May or June of this year. And again, going back up to the middle column, it's a fairly straightforward indicator. And you can clearly see 2008, you can see the crash, how assets were several months before, the assets were above 200 million, and then they crashed down to about 70 or 75 million or so, and the assets earlier this year came below 100 million. So this is a kind of a sentiment indicator tracking the retail sector, and fairly straightforward, makes a strong case that the market is very oversold. And this is a Commitment of Traders report. I'm sure you guys are probably somewhat familiar with this, but essentially there at the bottom, we're looking at the speculative long positions in silver. And again, as contrarians, we're looking at buying, obviously, when speculators have a very small position Especially given that we're in a bull market in gold and silver, and that we expect these lows to produce very strong rebounds. And that's another thing I'll just make very quickly as far as one thing in terms of trading precious metals, which is different from the other sectors, is the precious metal stocks are the most volatile sector, and also this is true with the metals. And typically, I think a lot of traders, they like buying breakouts, or they don't really like buying weakness. But buying weakness, especially if you're trading, buying weakness in precious metals is a much better strategy than buying breakouts because of the volatility and because these markets, they get so oversold. The snapback comes so far and so fast. So that's just a quick trading point I want to make. But looking at the speculative long positions here in silver, I think you can see the circles there. It was at the very end of last year in December. Precious metals actually made a low, I think, the last trading day or the second to last trading day. You can see that the speculative long position there was actually the lowest it's been in quite a while. I think it was actually the lowest since 2001. And in May, it wasn't quite as low as in December, but it was very, very close. And if you look at a 3-month moving average, my friend who's a fund manager in Australia and Hong Kong, he made this chart. He said that the 3-month moving average of these speculative long positions at the end of December was actually at its lowest point since 1997. So that's really telling. We're looking at a bull market here that's been going on since, in silver's case, 2001 or 2002. And this is pretty amazing here, given what happened in 2008, that we actually have speculators are less long recently than they were at that low. Now, and one thing as far as trading, I think, I'm more of a swing trader. I kind of look at, what do I think can make a lot of money over 6 months, 9 months, or 12 months. So I'm not a day trader type, although I try and follow things very closely. I think one thing that I like to do, even though my background is purely technical, you got to consider the fundamentals. You got to look at valuations. And so making a call, I wrote something in May that I thought we were going to have a major bottom. And everything, you have to look at, just the technical analysis, the sentiment indicators, a couple of which I just showed you, then also fundamentals. And these are the senior gold miners, their price versus cash flow. And I think a lot of analysts in this industry, they focus more on cash flow than earnings. Just because cash flow, it really gives a better idea of the asset. For a producer, is the mine making, are they able to make money? Because there's so many other costs. There can be a huge capex that they're putting into a second project, or one quarter they could have a huge tax refund or tax credit because of something, and then the next quarter they lost money because the Canadian dollar was way too strong, something like that. So that's a reason why analysts focus on cash flow, and that's something that I also focus on. And you don't need me to tell you what this chart says. You can see there in back at the very end of 2000, it hit a low, and then we had a spike low at the end of 2008, and there we can see earlier this year the comparable level in the price to cash flow for the senior producers. Now, moving to the more technical side of things, one thing that I've noticed, and I've studied the last 4 or 5 bull markets in equities, and essentially, we had the tech bull market in the 80s and 90s. If you go back from the late 60s to 1990, you had a bull market in Japan. We even had a bull market in Hong Kong from about, I believe, 75 to about 95 or so. And before that, we had a bull market in the gold stocks from 1960 to 1980. If you want to see a great chart of that bull market in the gold stocks, you can go to, it's a simple website. It's bgmi.us. Again, bgmi.us. It has a gold stock index that goes back to the late 30s. And even before that, I looked at the bull market from 42 to 66 in the Dow. And getting to my point here, one thing I've noticed about all these equity bull markets is they follow a similar pattern. They tend to go up for 6 to 8 years or so, maybe you could say 7 years in the first phase, and then there's a huge decline, a big correction that sets in, begins the second phase. And for all of these bull markets, it takes about 4 or 5 years for them to get past that first point, which in this chart is point A. I'll get to the chart in a second. And so those are your first two phases of an equity bull market. You have the first run up for about 7 years, and then you have the first crash, which sets in the wall of worry phase, and it takes 4 or 5 years to essentially break past point A. And so by the time you break past point A, you're in the 11th, 12th, or 13th year. And so essentially that brings in the last phase, which in some bull markets you can divide that into 2 phases. But in some bull markets, it's not quite as long. I mean, looking at the Dow Jones, it had its wall of worry from 46 to 1950. And so after it broke the 46 high, its third phase actually lasted 14 years, which was the longest. If you look at Japan, its phase B set in after 1973 with the oil crisis, and then Japan finally broke to new high in 78 or late 78. So its last phase lasted about 11 years. And looking at the tech bull market, 1987 obviously set in the second phase. And then it wasn't really until 90 or 91 that tech and the S&P really started to break away. So that was about 9 years. But actually the shortest amount of time was in the gold stocks. Again, they had a bull market from 60 to 80, and their first phase ended in 68, and they broke to a new high, I should say, in 1973. And so their last phase lasted 7 years. And the last phase for the gold stocks was actually the weakest compared to all of these, but I'll get back to that in a second. And so looking at this chart, you're probably wondering what it is. I should have told you. But in the top is the S&P, and the bottom is the Huey Gold Bug ETF, which follows the Huey very closely, is GDX. But again, we can see real similarities here between the S&P from 87 to 90 or 91 and the gold stocks from 2008 to 2012. And what's interesting is in both these markets, they actually made a marginal high. As you can see there, they made a marginal high right where I put the B. And the other bull markets did not make a marginal high. And so the fact that these markets made a marginal high, it shows a little bit more strength. And so the question is, okay, well, if the last gold stock bull market was the last phase was 7 years, then do we apply the 7 years from the end of 2010, or do we apply the 7 years from 2013, assuming the market, the Huey, the GDX breaks to a new all-time high in 2013? I'm not really sure. So we would apply that. We would get 2017 or 2020. I tend to be more on the 2017, 2018 side as a possible end to this bull market. But the main takeaway here is that, I mean, if the position that the gold stocks are in long term is very bullish, if they can continue to rally here and make a new high sometime next year, 5 years after point A, and that would set them up quite well to enter into that third phase. And again, going back, I mean, you guys just saw on the previous slides how sentiment and valuations earlier this year were at, I mean, we're talking about major lows, and you've only had, I mean, the major lows in this bull market, you had the beginning at the end of 2000, the next one was 2005, then you had 2008, and then you had just recently earlier this year. So looking at the last 5 years or so, this market has gone through 2 cyclical bear markets, and because gold stocks are very volatile, a cyclical bear market is really extreme. I mean, in 2008, we're looking at 70 or 80%, and in most of the the things that I'm looking at for the cyclical bull market in 2010 to 2011 was a minimum of 40%, 50, 60% in some other areas. But the point is, we're in a major bull market, and in the last 5 years, we've experienced 2 cyclical bull markets in the equities. And to me, that's a really good thing, because that's setting up. I mean, it's getting the weak investors out. A lot of people have forgotten about gold and gold stocks. Everyone thinks gold stocks are terrible. You can't make any money, et cetera, et cetera. So from a sentiment perspective, that's very healthy. And secondly, the valuations were super low, and I'm going to get to a little bit more of that later. And so we're really primed for a very good move over the next 5, 6, 7 years or so to finish this bull market. Okay, so here's a long-term case for a bubble or just really, really high prices. Now, this is a chart I made, but I have to double-check this. If you look at what I did here is I took the budget deficit over the last year, and I applied that over the next 3 years. And in addition to that, I also looked at how much debt we have to roll over, and so I divided that by 3 years to say that over the next couple years, in an average year, there's potentially $3 trillion that has to be financed. Now, the column on the left is 2011, which the funding needs were $1.3 trillion, and the Fed monetized $800 billion of that. Again, I really need to double check this with someone, but the main point here is if you go back to the financial crisis, how did Western nations get through that? Well, they took on huge amounts of debt. They ballooned their deficits, and in the case of most of these nations, a lot of that debt was taken on in short duration. I mean, we weren't taking on 20-year, 30-year debt. We were taking on 3, 4, or 5-year debt because the interest rates were so much lower. And it was easy to do. Well, the problem with that is a lot of that debt that's been taken on needs to be rolled over, and so that's really picking up substantially this year, 2013, 2014, and actually 2015. So and the debt burden has just gotten worse. I mean, even though we've kind of had a statistical economic recovery, the fact is it has not brought down debt to GDP. Debt to GDP in the U.S. and most other nations is getting worse, and that's because we had to take on even more debt to keep some people employed, stabilize things so we wouldn't go into a real deflationary 1930s scenario. But the problem is the economy just hasn't recovered that much. It's not growing fast enough to grow out of the problem like we saw in the earlier mid-1940s, and so looking at these numbers, that really means we're going to have permanent quantitative easing, and that tells you why the Fed recently announced open-ended QE, because they are going to have to they're not only going to have to continue to monetize, but in my opinion, they're going to have to monetize even more and more because the funding needs are getting bigger and bigger over the next couple years. And so if I'm correct about this, this is really the fundamental driving case for this precious metals bull market getting into that third phase. And getting into that third phase, we're moving into really high prices, and when you get to the second half of that third phase, that's when it carries you into the bubble. Now, one comment I want to make, because it just popped up in my mind, if you go back to the beginning of the third phase, well, actually, let's go back to the end of the second phase where we are now. You have contrarian bullish sentiment, but you also have really, really low valuations. So when the market breaks past the second phase and it makes a new high for the first time in 4 or 5 years, the reason it's able to continue rising substantially is because in that second phase, companies continue to make money, but these stocks are not making new highs. So that means that the valuations get better. And so essentially where we were in May or in summer is we had such super low valuations. You saw that chart. We had very, very low valuations, and so if companies continue to make money, the gold price goes up, margins go up, their earnings are going to go up even more, and you have essentially a compounding effect. I mean, if you're trading at 10 times earnings and your earnings double, but your valuation goes to 15 times earnings or 20 times earnings, it's a compounding effect. So that's really what drives the first half of the third phase, is that you have valuations increase because there's a lot of room to increase, and then earnings increase as well. And so you have a compounding effect. That's what drives the first half of the third phase. And because of that, you have stronger stock prices, you have a lot of momentum that kicks in, and that essentially drives the market into a bubble. Okay, now this chart shows gold just as a percentage of global assets. Go back to 1980, it was 14%, and if you go back to the beginning of this bull market, it was about 0.7%. Or so, and it's gone up to not quite 3%. But there's two comments I want to make here. First, what's very interesting is gold going up from about 0.7 of the global pie to now, let's just call it about 2.7. It has more to do with the fact that the value of gold went from 250 to now 1,700. So it doesn't tell you that there was there was more and more people buying gold. Of course, there are more people that are getting involved in gold. That's true. But gold, as far as a percentage of the global pie, is really being driven by the increase, I should say, is being driven by the fact that gold 10 years ago or 11, 12 years ago was under 300. Now it's 1,700. So that is a very important point to understand, that this increase is being driven not entirely, but I would say mostly by the fact that gold's value has gone up. Now, the second point, which is also important to understand, is now back then in 1980 and even the 1930s, there weren't as many inflation hedges. In 1980, nobody invested in emerging markets. I mean, who knew what emerging markets really were? It was a very, very small industry, small market. So today we have a lot more inflation hedges that are available. So I don't see this gold going back to 14% of the global pie. It's just not going to happen because there's better options for people out there. Not better options, but more options. Remember, you go back to the 1930s, gold was your only inflation hedge, basically. Now you can buy tips, you can buy emerging markets, et cetera, et cetera. Last point I want to make, you can see here in the black in the slide at the bottom, it says if gold's share doubled, it would amount to 66,000 tons, which is equivalent to 23 years of production at current levels. So for this share to double, that would equate to buying another 66,000 tons, and that's 23 years of gold production. So that is really a startling statistic that tells you that we really only need a little bit more demand to really overwhelm supply. And here's a great chart that my friend sent to me, and this shows gold divided by the S&P 500. I really prefer using this to the gold Dow ratio, just because the Dow is only 30 stocks and the S&P is a much broader index. In my opinion, it's a lot more useful. And looking at here is, if you go back, you can see the peaks in this chart are obviously above 4 in the 5 area, and currently, this was a couple months ago, we were at 1.2. And as you can see, what's very interesting is in the last two bull markets, I don't know if you can see my mouse, but if you just go back to the 5.8, you can see that the market really shot up in only 4 years or so to get to that 5.8. And the same thing is true if you go back to the 4.3. Actually, the first 4.3, if you're moving left to right, you can see that was below 1, and it shot up to 4.3 in about 3 years or so. Now, in this chart, we're looking at the stock side. This is the Barron's Gold Mining Index, which I spoke about before, which you can see at bgmi.us, and it's the BGMI divided by the S&P 500. This is 2 years old, but I did note that their current ratio is about 0.8, which going back the last 2 years, it really hasn't moved that much. And I put in a box the last bull market, and we're following a similar pattern. And that pattern is that this ratio, it doesn't really rise. Well, as far as the last bull market and this bull market, I should say, in the first 12 or 13 years, it didn't really rise that much. It increased, but you didn't get a spike. The spike didn't really come in the last bull market until the mid-70s, and then after a correction, you had another spike. But going back to the last chart, the gold versus the S&P, the thing you notice is that the huge rise in these ratios, they occur very fast, very quickly, and only in a matter of a couple years. So that's very telling, because look where we are. We're 12, 13 years, or 12 years into this bull market, almost in the 13th year, and you can see that against the S&P, this has barely moved. So someone would say, yeah, this is not going back to 8, 5, or 10. That's just too, that's too much for it to rise in a short amount of time. But again, if you're looking at this chart, you look at the last chart, you're looking at history, it's very clear that this rapid outperformance at the end of the bull market it happens very quickly, and it only happens in 2, 3, 4 years. Now, one of my favorite types of technical analysis is intermarket analysis. I like to follow bonds and all the other markets because that's very important. I mean, the reason why precious metals do well is usually because people are disenchanted, or they're not bullish on other assets. I mean, if stocks are doing well, nobody's going to buy gold or gold stocks. If bonds are doing well, less people are going to put their money in gold for safety. And so what we're looking at here on the top is silver divided by the 30-year bond. On the bottom, that's gold divided by the 30-year bond. And so I think this is something very, very important to watch. Essentially, the next breakout move will have, in relative terms, gold and silver will be trading at an all-time high relative to bonds. And I mean, you guys out there obviously know very well what that means when you make a new all-time high for the first time in quite a while. Now, I'm looking at my time here, so I'm going to need to speed up. I'll get to the next slide. This is something I'm looking at. These are trend channels. They're all parallel. And essentially, I think if this bull market is going to continue, I'm looking at in 2013, we have resistance at about 2350 and then 2550 at the end of the year. At the end of 2014, early 2015, we have resistance at 3,500. And when we get to the bubble phase, I think the bubble phase would be when gold breaks above this C trend line here. And so that could be breaking above something in the mid 3,000s in 2515, or maybe 4,000 in 2016. So that's kind of, how do you know if gold's going into a bubble? Well, it's probably going to break above 3,500 to 4,000. Okay, so how do we apply this? How do I apply this going forward? Again, here's the chart you already saw. The point, I already made this point, but the point is the valuations are, they were at 6-7 times cash flow. I mean, these valuations can double, and if the valuations double, the stock price can double without the companies producing any greater cash flow. So that's the point. You have the compounding effect of rising earnings, rising cash flow, combined with rising valuations. Now, this is a test case I'm looking at just to show you how much a potential company can rise. There's probably only a couple companies that can actually fit this test, but if you look here at, in the first row, we have 10 times cash flow. We're using $600 is a cash flow margin. So their cash flow is $60 million at 10 times $600 million. Again, the second scenario, you have a 2,300 gold price. the margin goes up, greater cash flow, greater valuation, and so you can really see how greater production. In the case of these companies, you have three things. You have the greater margins because of the higher gold price. You have the greater valuation because things are getting better. We're not at a bottom. And then thirdly, if they can increase their production, they're going to make more money anyway. So this is a test case to show you potentially how much some of these companies can rise. Now, what I look for is growth and speculation. When I'm speculating, I use warrants. There's a lot of Canadian publicly traded warrants. And also when you're looking at non-producing companies, explorers and developers, those are a speculation. They're not real businesses. So that's what happens with those. They're not real businesses. As far as growth, you have to focus on growth-oriented producers. The royalty companies also fit in there. And so I have to end this because I'm looking at the time, but if anyone wants to have this PDF of the presentation, I can send it to you. You can email me at jordan@thedailygold.com. Chuck, I don't know how much time we have for, but I'm sorry if I went a little too long there on the middle of the presentation.
Not a problem. Let's see if anybody's typing in anything. A lot of times with these presentations, Jordan, people sit back and wait for the recording and then try and ask the question there. But having your email address, jordan@thedailygold.com, that's a pretty good way to get in touch with Jordan if you do have any questions. And Greg has a quick question for you, Jordan.
No, I do not run a fund. That's something I would like to get into eventually, but I have a newsletter, a premium service. It's pretty inexpensive. It's $150 for 6 months. If you go on, you send me an email, I can point you to it. And I focus on all these things that I was mentioning. And is GLD a good way to invest in gold? I mean, that's a whole nother can of worms. I think it's a good trading device. CEF is something I would look at. CEF, it's a Canadian fund. It's about half gold, half silver. They do own all the metal. So as far as owning gold through an ETF, CEF is what I would prefer. Who are the producers? Well, a lot of this is premium information, but one thing I'm going to say, you have to, I mean, I don't know how many Canadians we have here, but there's a lot of these great mining companies. They're in Canada to begin with. By the time they get to the U.S., they've already gone up substantially, like a Silver Wheaton. That's something I owned in 2005 before it got on the big board. You should look at the royalty companies, Silver Wheaton for silver, Franco-Nevada for gold. Sandstorm is an up-and-coming royalty company for gold. The symbols are SAND, FNV for Franco, SLW for Silver Wheaton. Those are three excellent royalty companies. I'm not saying buy them right now. I'd have to look at them more closely. I own some of the Franco-Nevada warrants because they offer exceptional leverage. Again, that's a whole nother conversation, but those are three companies I'd mention. The royalty companies they're pretty trusty performers. How about NUG and SIL? SIL is the Silver Stocks ETF, and I do like that. One thing I'd mention as far as the short term, if you look at the short-term charts, the stocks right now are really performing better than the metals, and that is an excellent sign because the stocks always lead the metals, and so the metals have kind of been struggling, but I think the stocks have bottomed and ended their correction. So in the short term, I'm actually pretty excited. This is I think a good time to get involved.
Okay,
how much time do we have? I know there's more questions, but I would just direct the questions to my email.
Yeah, and that's certainly what we'll do. So if anybody has any further questions, please feel free to send an email to Jordan. We're going to go ahead and move on to our next presenter here. But Jordan, thank you for coming in today.
Okay, thank you so much for having me, Chuck. And again, I would just send me your questions over an email. I can get to those, jordan@thedailygold.com.
Okay, and our next presenter is Josh